or violate the price level and continue in its prior direction. It may break the resistance or it may break the support. Anyway, until it hits the next support or resistance level, it will make another resistance and the support level. We will discuss it at the next page. Anyway, the timing of some trade is based on the belief that support and resistance level will not be broken. Whether the price is stopped by or break through the support or resistance level, traders can bet on the direction of price and can quickly determine if they are correct. If the price moves in the wrong direction, say break through the resistance or break through the support level, the position can be closed as a small loss. If the price moves in the right direction, respect prior support, so they bounce back or revert, the move may be substantial. Support and resistance can be found in all charting time periods, daily, weekly, and monthly. And traders also find support and resistance in smaller time frames, like 1 minute and even 1 second, or even a 5 minute and a very short-term time period. But the longer the time period, the more significant the support or resistance. To identify support or resistance, you have to look back at the chart to find a significant pause in a price decline or rise. So it's very subjective. When the price moves like in this way, you just put a line at the high and the lows. So it will be the resistance and the support. So it's very subjective. Anyway, then look forward to see whether a price stop or reverse as it approaches the level. So from here is the future. So you see whether the price meet the resistance or support level. As has been noted above, many experienced traders will pay attention to past support or resistance level and place traders in expectation of a future or similar reaction at this level. So they predict the price will down if they reach the resistance level and bounce back if they reach the support line. And as you can guess, technical analysis is not an exact science, and sometimes the price will dip below the support level, break the support level, or reverse before it gets to the price support level. Just rebounds here before touching this support line. And the same is true for resistance. Price may reverse before it touches the resistance level or break above it. In each case, flexibility is required in interpreting these chart patterns. An interesting phenomenon in technical analysis is that support and resistance level can change their roles. If the price breaks the resistance level and goes up, the existing resistance level becomes a new support level. And if the price breaks the support level and goes down, the existing support level becomes a new resistance level. One reason is the investor psychology. Traders who previously sold the stock at the resistance level here, traders who previously sell their stock at the resistance level may now believe that the stock has stronger momentum. Say you sold the stock because it reached the resistance level in a belief that the stock will revert back. But if the stock breaks through the resistance level and go up, you now believe the stock has a strong momentum than you thought. In that case, you will start believing that the price will never fall back below this resistance level, which becomes a new support level. And the opposite situation can also occur. If the price falls below a support level, that support level may become a new resistance level in the future. This role reversals are frequently observed in financial markets, which is why technical analysts closely monitor breakouts of support and resistance level. And technical analysts also study chart patterns beyond the resistance and support levels, which are recurring shapes that appear in price charts. These patterns are generally divided into two main categories, reversal patterns and continuation patterns. A reversal pattern signals that the current trend may be ending and that the price may start moving in the opposite direction. For instance, if a stock has been rising for a long period, a reversal pattern suggests that the upward trend is about to turn into a downward trend. And common examples of reversal patterns include head and shoulders, inverse head and shoulders, and the double tops and double bottoms, and triple tops and triple bottoms. So these are the names of the common chart patterns. On the other hand, the continuation patterns suggest that the current trend will likely continue rather than reverse. So if you see some patterns called a triangle or rectangle patterns, you will expect the current trend will continue. And these patterns often occur during a temporary pause in the trend, where the market consolidates before continuing in the same direction. So understanding whether a pattern indicates a reversal or continuation is an important part of technical analysis. And one of the most widely recognized and used reversal pattern in technical analysis is the head and shoulder pattern. This pattern typically signals that an upward trend may be coming to an end and start to reverse. The pattern consists of 3 peaks. A left shoulder and a higher peak called the head, and the right shoulders. So this right shoulder usually similar in height to the left shoulder. And another important element in this pattern is the trading volume. In many cases, trading volume is relatively high during the formation of the left shoulder, so high volume. in left shoulder and the head, but it tends to decline during the formation of the right shoulder, so lower volume in the right shoulder. So this decline in volume may indicate weakening by pressure. So one very important condition for identifying a head and shoulder pattern is that there must be a clear prior uptrend. So when there is a clear uptrend and a left shoulder with a high volume, and if there is a higher head with the high volume during an uptrend, and when there is a right shoulder with similar height with the left shoulder with lower volume, it indicates the trend. This uptrend will soon end and start to reverse and turn into the downward trend. So this is called a reversal pattern. So remember, this head and shoulder is a reversal pattern. That means the pattern in the previous uptrend is signaling the end of an existing trend and start to reverse and trend toward the downward trend. If there is no upper trend in the prior period, then the pattern cannot really represent a reversal. Say there is no uptrend, say there is a sideways trend like this. So the head is a little bit higher than the left shoulder, then it does not really show a reversal pattern. So the head and shoulder pattern should have a clear previous upper or current upper trend with a high volume. And when there is a right shoulder with a similar height with a left shoulder with a lower volume, it indicates toward a downward trend. So this is the example of the head and shoulder pattern. You can see that there are three key parts of the pattern: the left shoulder, the head, and the right shoulder. The middle peak, which is the head, is higher than the two shoulders. So higher than the two shoulders. Another important feature is the neckline, which connects the two troughs between the shoulders and the head. So it's kind of a support level, right? And there is a clear previous uptrend. So higher highs and higher lows. And technical analysts often monitor closely to see whether the price breaks below the neckline. So here is the very important part. So if the price breaks the neckline or the support level during the head and shoulder patterns, it becomes interpreted as a confirmation of the trend reversal. So if the price falls below the neckline in the head and shoulder pattern, it is often interpreted as a confirmation of the trend reversal, suggesting that the previous upward trend may now turn into a downward trend. Again, traders often look at trading volumes at this stage. A strong increase in volume during the breakout here. So volume confirms the price, right? So the strong increase in volume during the breakout may strengthen the signal. This slide shows the inverse head and shoulder patterns. Inverse head and shoulder patterns. This is also the reversal pattern, which is essentially the opposite of the head and shoulder patterns. So opposite.